All right. Hi, guys. Welcome to our Junior Investors Club. Today is a very special session. We don't have this often. It is an open Q&A session where you can really ask anything you ever wanted to ask to a full-time investor, right? For those inside JIC, today's hashtag is 0709 Q&A. So if you've got any questions regarding to today's session, please use the hashtag in the Telegram, right? So just a quick disclaimer, this class is recorded on Zoom, archived in the Knowledge Vault, right? This Knowledge Vault is a separate place where we keep all our archived videos, right? Every week we run 2 classes and all the recordings are kept inside the vault. And this year, the vault is called JIC Vault 21 for all this year's content. Right, next year we'll probably do a New Year's vault, right? So stay tuned, right? I'm teaching theory in all my lessons, so any stock references will be only for education and teaching purposes only. Okay, none of this is stock tips or financial advice, right? So all of this is really for education only, right? Education and referencing, right? I didn't ask you directly to go and buy or do anything like that, right? Most importantly, always portfolio size and do your own due diligence. That means that you guys need to be responsible, 100% responsible for all the actions that you take on your portfolio, right? Nobody force you to do anything you are not comfortable with, that you disagree with, that you don't understand. So before you do anything, always make sure you fully understand the risks, understand the mechanisms, understand the entry, the exit, the reasons behind certain strategies, and you'll be good, right? Definitely no bad thing will happen to you if you take full responsibility for your own actions, right? And finally, for our guys inside JIC, please help me to do survey, right? Once I'm done, so that we can streamline all our sessions so that you guys get the best education possible when you're here with us in the Junior Investors Club, right? This is just a bunch of the stuff that we have inside our website, right? Most of the time we are the main, I would say, product, I guess, right? The main thing is the bit.ly/JIC support, right? This thing, right? So if you want to join our live community, it is a live Telegram. It has live classes such as this. Today is actually one of the live classes that we conduct, right? It's all inside here. So you just need to register yourself. It is a subscription-based program, $97 a month. No obligation. If you don't like it, you can just end your subscription anytime. No issues, right? And then Vault is the Vault. That's where we keep all our archive. Then the rest, you guys don't really need to know so much about it, right? It's not very relevant or important for today, right? Let's see. Why this one again? Okay, website www.junierinvestors.club, right? I'll put all the relevant links in the Telegram, right? The free previews, bit.ly/JIC preview. This one, I guess you all know already. Blah blah blah. This one not so important. All the basics are inside the teachables, right? If you do need to access or learn some basic stuff, they are all available for free, right? Inside the teachables, so they can be found in here in the preview or inside your homepage as well, right? Yeah, and that's the end of the slides, right? Nothing much for that, right? Okay. Let's see. So that's the end of all this disclaimer stuff. Let's get on with the session, right? Ash, you are Ethan, right? I know you. Hello, right? So Ethan is one of our new friends. He just joined to Walking with Dinosaur program. So make sure do we need to track and put all that on? No, right? That one is a template for your future trades, right? It's just so that we can keep track of how your trades are doing properly, right? In case you guys are not sure, Walking with Dinosaur is our portfolio review program, right? That's when we have a quick interview and a discussion with you guys to fully understand what sort of trader/investor you are, right? So that we get to know your temperament, your availability, right? Your dedication, because and your lifestyle, because everybody really functions on a different wavelength, and there's no cookie cutter built for any of these things, right? So we really need to know who you are as a person, and then we can design strategies that your lifestyle can support, right? No point doing a very active style trading to somebody who only open thing or swim once a month, right? And also there's no point doing such a slow trade for people who are very free and every day want to open thing or swim, have a lot of time to dedicate, right? So that is the Walking Dinosaur program, right? And then of course we monitor your progress for half a year or 1 year, depending on what you bought, right? Depending on which package you subscribe to. We got half a year and we've got 1 year where we monitor together with you, and then any sort of changes that we need to adjust along the way, then we will go and advise and say, okay, time has changed, we need to go and shift a little bit of things, or perhaps your lifestyle has changed and you need to reshift things. So we help you to design something that can that your lifestyle can support, right? Right? Does that answer your question, Ethan? Right? So you need to track your trades inside the template so that we also can monitor and we know how your portfolio is going, right? Let's see. Eileen, what is the best way to do stop loss for buy call profits if don't know whether it will still go up any further? Very good question. We did a session about this, like exactly this thing last week, right? But just to share with you, this my, can you guys see my paper money? Can you guys see my thing on Sim? Right? Yeah, let me go and make the words bigger. Normally, I will like to make the words bigger. Big, can read? Can read? All right, big enough, huh? Okay, very good. Okay, so your question is, right, what is the best way to do a stop loss for buy call profits if you don't know in the future if it will go up or not, right? Now, the best way to answer this is, first things first, you do need to know whether it will go up or not, right? You do need to have some foresight whether it's going to go up, and how you do that really is by simple technical analysis, right? Technical analysis is step one. Some of my guys will already know this, but I was talking about Disney last week, and let me showcase to you what I mean, right? Let me showcase to you what I mean. So first things first, we always want to go back to our charts, right? We have got a lot of different indicators that we've learned inside the Junior Investors Club. Let me just shift to something basic, right? All right, so first things first, you always need to know whether there are any sort of, what is the market environment happening, right? What is the market environment that is happening right now? We all understand that it's a sideways market, but even in a sideways market, the trend still goes up and down, right? Are you familiar with drawing trend lines? Right? Are you familiar with drawing something like this? Right? So typically we want to start off with something like this first. Yeah. Typically we want to start off with something like this. Right? Okay. Okay, this one. Typically we want to start off with something simple like drawing trend lines. I know everything is okay. I've only got a certain bunch of favorite colors. Let's choose something else. Orange. I don't think I've used orange yet. Right? Typically, you want to start off with drawing something like a trend line, where you can see whether the stock is really at the top or at the bottom, right? And then you can tell whether there's going to be breakouts or not, right? And you know at roughly where the range is happening, right? So if your stock has already reached the top and you have drawn your trend line, typically when you see when it reaches the top, it will tend to come back down, right? This is one way to tell. Right? This is one way to tell. The other, once you can preempt, or once you have a good sensing of whether your thing is going to go up or down, right, then you can decide whether you want to still remain in the trade or decide whether you want to take profit, right? One of my favorite, so let's take a look at a position that I've already placed previously. Right, let me go and hide all these things. Yeah. Right. So let's see, your example is on a buy call, right? Yeah, buy call. So let me open up my buy call here. Right, so I've got a Disney 170 buy call. Current price of Disney is 181, right? Now, what is the best way to keep your profits, right? Right now, we saw in the chart just now that Disney has reached the top and is going to rebound, right? But it's going to still remain within that range, so I'm not particularly hyper worried about that. But for this example, I've already profited about 20%, right? You can see I've already grown 20% from this trade. And how best to protect this trade from rebound, right, is one of the things I like to call trail stops, right? So I simply right-click, right, create closing order, and I sell, right? I sell Disney. So it looks like I'm going to close the trade. Looks like I'm going to close the trade, but instead I've set it to trail stop. Okay, so a lot of people will ask me what is a different, whether I'm saying a trail stop, a stop limit, or whatever other thing. When I use my terminology, I'm very specific, right? So when I say trail stop, I mean trail stop, not trail stop limit, not stop limit, not stop, not limit, not just trail, right? Trail stop. Right? So I use trail stop. And then you simply take a look at what is 10% of your trade price. So I paid $23.55, right? 10% is $2.35, right? So you can simply do a trail stop of about $2.35, right? So, and of course you set yourself to GTC, then you confirm and you send. So what that means, right? What I just did is I set myself an automatic exit order. If my position retrace and I lose 10%, that's when I will automatically exit, right? But if it grows 20%, 30, 40, 50, it goes up and up and up, I will not close the position, right? So the moment, right, my current trade right now is worth $28.35. I bought it at $23, right? Let me just highlight. I paid 23.55. Current price is 28.35, right? So I actually profit about $4.80, right? 4.80. So this is my profit. What I have done is I've set myself a profit of 20%, right? What I have literally done is I've set myself a 10% trail stop. That means the moment the market price moves negative $2.35, that's when I'll exit my trade. And that 2.35 is actually 10%, right? So the moment 28.35 backtrack $2.35, I will exit the trade. That means I will take profit at 28.635, about $25, right? So I actually protect 10% of the top at all times, right? Do you understand this? So this is how I use automatic orders to actually protect my profits, right? So the moment the position backtracks 10%, I'm automatically exit. But if it goes up and up and up, 10%, 20, 30, 40, 50, I'm still in the trade. But the moment it retraces 10%, because I indicated $2.35 is 10%, the moment it retraces 10%, that's when the trade will self-eject, and I will just close the trade and take my, it will automatically close the trade for me, and then I'll take my profits, right? Does that answer your question? Right? Is that clear? 10% from market price, right? From this. So I'm not referring to, I'm no longer referring to the stock price anymore, right? It's not 10% of the stock price, okay? 10% of its own price, right? 10% of its own price, okay? So it's not counting from the stock anymore, right? Please, once you open your option, disregard, right? Disregard the stock price already. Only refer to your option price. Your options count itself, okay? And of course, your option price will be related to the stock movement, but it's not, but everything you count internally counts from the option itself, right? The option count the option, right? We don't really need to refer to the stocks anymore. Okay. Does that help? All right. Now, so that's how I do it. Yeah? It's this is a trail stop, Dave. Trail stop, right? Right? It's a trail stop, right? So this setting will not close if buy call continues to go up. Yes, correct. If it moves anything other than minus 235, it will keep going, right? The moment it moves minus 235, then it will exit. So anything that is not minus 235, minus $2, minus $1, it will still keep going, right? Plus $2, plus $3, plus $4, plus $5, it will still keep going, going and going and going until the moment it moves minus 235, right? And there's a directionality also when you do trail stops, right? You can design it to be negative or positive, right? But for this, for buy calls, most of the time, for anything buy position, we typically want to have it as a negative position because negative means it retraces, right? So negative means it retraces. So you can do it this way, right? Dave said this is good for big movement stocks like Moderna, right? Good question, Chris. So what happens if it suddenly moves minus 30%, right? We have already set a trail stop of minus 10%. And this is what I want to advise against relying too much on as well, right? Just now I talked about looking at your technical analysis chart, right? I didn't go very in-depth about that, but that is very important to always keep an eye on, right? We don't really want to go into areas where there's a sudden drop off like that, right? Because if it drops so suddenly, right, minus 30% in the pre-market, right, that's the worst case scenario, right? If in the pre-market it moves minus 30%, it will exit at minus 30%, right? You set it at minus 10%, but it will always try to take the closest price. So the moment the market open and is down 30%, it will just automatically exit itself at minus 30%, right? Throughout the stock market trading day, right, it will not suddenly move 30% in like 5 minutes, this kind of thing. So the moment it moves 2, 3, 4, 5, 6, 7, 8, 9, 10, it will just exit, right? It will not be so sudden one. But those sudden things usually happen in the pre-market where it gaps up and down. And that's the dangerous thing for trail stops or any automatic orders in general, right? They cannot handle sudden drops like that, especially when it is in the pre-market, right? But during the day, you can handle, but when the market is closed and then the next day open at a very drastic level, that's when it's very, that's when it will go wrong. It will just close at when the market open, it will just close at whatever price it opens at, right? So in order to mitigate that, I always advise people to be very watchful about their technical analysis, right? You do need to be quite good at this kind of things, right? Reading the charts, right? So that you can assess whether there will be sudden drops, right? Like if you see a candle like this, right? This is quite sudden, right? This is quite sudden. Of course, it's an earnings day, so it's sudden, but it's not unexpected, right? So if you know it will suddenly move like that, but you expect it to suddenly move like that, then our rule about earnings is don't go and trade into earnings, because it will be chaotic. So don't go and do anything in that very chaotic period, right? It's chaotic, therefore you definitely can have the full power to avoid such a thing, right? So yeah, this is how it is, right? So does that answer your question, right? If it suddenly drop, then you will just close at the sudden drop price when it opens, right? So you do need to be aware when it will, if it do suddenly drop, you still can turn off the thing, right? You can still cancel the trade. Like let's just say your trade suddenly drop, right? Let's just say the trade suddenly drop in the pre-market, right? You can always cancel your order, right? In case you don't want to be filled. But here's the thing, right? If you do set your exit strategy, best not to mess around with it, right? You put it there for a reason, to exit in case of emergency like this. So this is actually the ideal situation to exit at. Okay, you have set it so like that, so don't go and change it, right? Best you not mess around with your exit strategy, right? That always causes a lot. There's also a big failure point in a lot of other investors, where they get a bit too greedy and then they want to change their exit strategy, right? Stick to your plan. If you want to have a different exit strategy, do it on the next trade, right? Do it on the next trade. This one, you take your money, you go. Next trade, if you need to readjust your strategies a bit, do it on the next trade, because it's very difficult to do it on a trade that is currently running. You will already screw up all the plans that you have already pre-planned, right? You just let it go through, all right? Let it go through its due course. Then you analyze, right? You keep track of what's happening. Then your next trade, definitely you can readjust to do something a bit better and optimize, right? It's a bit, how do I say, not very optimal to go and tweak things in the middle, because it's very hard to keep track of your results if you change things in the middle like that, right? So just compartmentalize each trade into its own individual instance. Then you can keep track of how you are progressing as well, right? Yeah, good. That's a very good question, right? Louis said, exit before earnings, enter after earnings. Yes, that's exactly correct, right? Usually for earnings type of trade, right? There's a lot of people also enjoying advertising about earnings trades, right? And those are the people out there who are doing the courses and selling the programs, right? They do enjoy talking about amazing earnings trades and all these things. But for the people actually practicing, right, the results are not as advertised, right? Hardly so, especially this period, right? So typically we don't go into earnings. As an experienced investor, many of us have experienced that. We know that earnings is really random. You cannot depend on anything. You cannot predict an earnings experience, right? An earnings result, right? The result may come up and the results may be fantastic, but the sentiment may betray you, right? The sentiment, what's more important, the results or the feeling how the results are, right? Which one is more important, the results or the feeling of the results, right? The actual results or how people feel about the results, which one is more important, right? Which one actually shifts the market, the results of the earnings or how people feel about the results of the earnings, right? Which one actually affects the market, right? For me, I personally feel that it's people's feelings about the results that affect the market, right? The results can be good, but if people feel they want to take profit, I don't care what is the earning results, they will take profit and they will drop the thing like this, right? Then sometimes the earnings may be bad, right? But people feel that it's not as bad as what they advertise it to be, right? Then they still shoot up the stock anyway, right? So it's really, the results of the earnings is really not 100% related to the price movement, right? Yeah, like Zoom and Amazon, the earnings is very good, but yet it gapped down suddenly, right? Why is that so? I talked about this a bit earlier in the preamble, right? That's because this period, right? This is the September period already, and in fact, this whole year in general, people are not highly confident of the stock market. They are still waiting for stimulus, for any sort of economic shake-up for the thing, right? But nothing is happening economy-wise in America, right? We are mainly trading on the US stock market, and from last year until this year, nobody. It seems like they have just left the stock market one corner and they have put all their focus on other things. That's why the economy is not really stimulated, right? We talked about this last year, in fact, right? That we say if Biden wins, it's not going to be explosive like the age of Donald Trump, right? Because his focus is really on lots of other things at the moment. And this is why when there are good earnings results, people still crash the stock because they are taking profit, right? So don't depend on earnings results. Go and look at people's reaction to it, That one is a bit more important, right? The reaction to the results, right, tells the real story, right? And the real story is, look at this huge volume of selling, right, on Disney, right? Let's take a look at what the earnings actually is. Right? What does it say? Yeah, estimated. Yeah, it went up, right? From the estimated result was 56 cents, but they earned 8 cents, right? 80 cents, right? 56 to 80, right? So it's better than expected, but yet people crash the stock, right? Because people want to take their profit, they are not confident in holding, right? And this gives you a good clue on the market environment and what you should do actually, right? If you are properly invested and you are tracking all these things, if everybody is, you know, they have the saying called the trend is your friend, right? Go with the flow, the trend is your friend. If everybody is taking profit, right? If everybody is taking profit, why are you holding, right? Why are you holding onto a 2-year trade when everybody is taking profit whenever the time is right? Here, close trades, here they close, right? Here, maybe can take profit, here re-enter, here exit, here re-enter, here exit, right? It's very clear what is happening in the market. You definitely cannot close your eyes, do a 2-year position and hope for the best, right? Because you are losing out to time decay, right? Those strategies are not suitable for the year 2021. You will find yourself burning a lot of money, right? For no reason, and nobody can really answer you. I guess the only people that will answer you is me, right? I can answer why you are losing money, right? But it's very clear that this is not a good year to hold, right? Hold. How long you want to hold? How long do you want to hold? For 1 year, you're going to lose. For around 1 year, maybe you will be losing money, right? If you don't need money for the whole of 2021, then maybe buy and hold strategy will work for you. But if you are an active investor and you need the income, right, it's better to be nimble, right? Look at all these, so many opportunities to enter and exit, right? So many trades that we do every month, right? We are not doing 1 year, 2 year positions and then wait, right? What are you going to do for 2 years, right? You do a 2-year call. What are you going to do in between, right? Definitely you cannot just sit down and twiddle your thumbs, right? Definitely you do need to, you want to generate what we call cash flow. And look at all these entries and exits that I've highlighted for you, right? Very, there's so many opportunities, right? If you know how to ride the waves, you can go in and out, right? Like a dolphin, right? You jump up and down the waves, jump up and down the waves, and you can definitely earn a lot of, you can definitely generate a lot of, you enter here, exit here, right? Then you wait, enter here, then you can wait, exit here, right? Enter here, exit here. Look at it. Look at this dotted line. This is within 1 month, right? Let me go and clear. Right? Let me look at all the opportunities within a month, right? Here you enter, right? Here you exit, right? Here you enter, then you next month already, right? Here you exit, right? Maybe you exit here, then you enter here again, right? You got you can earn 2 times, you can earn twice in what's this, month number 6, July, right? Oh, June, right? Month number 6, you got 2 entries and 2 exits, right? June, you got 1 entry, 1 exit, right? You got 1 entry, 1 exit, 1 entry, 1 exit, 1 entry in the month of 7, June, July. Yeah, this is June, May, June, July, right? July got so many as well, right? So many entry. Then you only do a 2-year position and then you forgo everything in here, right? 3 months of possible optimized profits that you forgo because people tell you do a 2-year call, right? Usually, how long for buy call for expiry date do I choose, right? Okay, let's answer it in sequence, right? Dave said, is there a point for buying a 2 years call? There are points. So this is the thing, right? It's not about just working out strategies, right? The market will tell you what strategy is optimal to use, right? In a bull market like what we have last year, when the stock market just shoot up, then the buy call long time is very good, right? I personally used those strategies last year when the market was in bull run, right? And that's how I earned a lot of money, right? But this year is sideways. So you cannot use a bull strategy in a sideways market, right? Like I said, the bull market, you do bull strategy. Bear market, you do bear strategy. Sideways market, you can do sideways strategy. Right now, it's a sideways market. There's 2 ways to navigate this. Either you be very passive and you wait it out if you are unsure how to do, or you be very active and you catch every single wave that's happening, right? So many micro waves in a trend, right? That you can certainly capitalize on, right? So the point being that different timing require different strategies, right, Dave? You understand? Not everything works in every market. Different market need different strategies. And this market, the 2-year lead call will not do well, right? It will lose to time decay, like we talked about in Greek's class, right? 2 years, your stock is not moving. A buy call requires your stocks to move. Your stock is not moving at the start of the year, end of the year, it still end up at the same place. You lose to time decay, right? So you don't, that is really not optimal, right? So Eileen, usually how long for buy calls for expiry dates do I choose? These days, I don't do buy calls so often, right? But what I find that works very well, especially if you are, okay, first thing first, you need to know what is your style. Are you very active? Are you able to keep track of the market, of the charting, right? How is your charting? If your charting is a bit slow, right, and you are not able to catch periods like this, right? About 3-4 months buy call is all right, right? You buy when it's, always look at your charts, right? Always buy call when it's at support or when it's low, and exit when it's on top. So within 1 month, I've already got 1 entry, 1 exit, 1 entry, 1 exit, right? So you can do like, you know, if you are very observant or watchful, right, a 3 months one should give you enough. A 3-month buy call will give you enough space to make mistakes, right? And what is a mistake? What is a mistake? A mistake is that you hold too long, right? If you buy a 1 month one, right? If you buy a 1 month trade, right? If you buy a 1 month buy call, look, my red dotted lines are months, okay? So if you buy a 1 month buy call, 1, 2, 3, 4, right? Each month got 4 weeks. By week 1 or week 2, you must exit already, right? Best if you exit by week 1 itself. If you buy 1 month, you should exit within the first week, first or week, second week, right? Sometimes they take a bit longer to reach their peak, right? So you give yourself a bit more leeway for error, right? You give yourself a bit more space to make mistakes, right? Now that may be very difficult for newbies, right? It's a bit scary to enter such a short trade and not see results and then exit it. Like, what's the point of doing that? So, you know, a 3-month one will give you good amount of time to maneuver and learn from your mistakes, right? It will not be very expensive, but it will not exactly be very cheap as well, but it's good enough that you can learn. So what we want to do is always, if you are doing a bullish strategy, right? Something like a buy call, you always want to enter at the supports, right? Every time it reaches the bottom, you want to do 1 3-month buy call or something like that, right? The moment it reaches the top, you exit. I don't care how much time you have, right? You can buy a 3-month, look at this. You can buy a 3-month call, right? And within 1 week, you exit, perfectly fine. Take your money and go. Because what's going to happen is it's going to retrace back down to where you started and you just wasted all that time, right? Take the money and go, right? Then once, and we understand and we know very well that this is a sideways market, right? Definitely the entry will come again, right? Once you're done with your trade, you wait for the next one here, right? Then within the same week, look at this box. Within 1 week, you can reach on top here. Then you just take it and go, right? Take it and go. Then you rinse and repeat. Every month, you can get several entries and exits, right? Every month, you can get several entries and exits if you are astute and you are watchful, right? If you are a bit more slow, right? Best if you go and harvest stocks instead, right? Options is not really very good for those not very vigilant, right? You do need to be aware of the time you have left, right? And you do need to be aware of what the market situations is like, right? Does that answer your question? Buy at low and exit with trail stop and all that. You can just exit it by yourself, right? You can just right click close. You don't really need to use trail stop. Trail stop is for if you are not going to watch it, right? If you are somehow not interested in watching it, then a trail stop is fine. But it's better to watch it, right? I always advise it because sometimes it can get down and then your trail stop is ruined anyway, right? Trail stop is ruined anyway, right? And it doesn't help if you are not so if it gaps down suddenly like this, right? So especially if you are aware that earnings are coming, do just take your profits and go, right? You don't really want to occur this thing, right? Let this thing occur, right? So do take note, okay? So let's see, huh? So Dave said this multiple entries use options. Yeah, each one that I highlight is a trade in itself, right? Right. This one is one buy, call, entry, and exit, right? See, one entry down here, one exit down here, right? Then you can wait again, right? Then if you want to take a break, one entry, one exit, right? Finish one trade, right? One entry, one exit, finish another trade, right? So you can do it like that, right? And then if you are very good at bearish, you can do one entry, one exit here as well, right? Bear position, one entry, one exit, right? So actually you can entry, exit, entry, exit, entry, exit, entry, exit, entry, exit, entry, exit, entry, exit. Then you can double up your performance as well if you are very good at doing both directions as well, right? So that's it's pretty cool, right? Let's see. Next question, Ethan. So what is the strategy that has worked best for my style? What is my style in the first place? And how do I scan best for best opportunities? Very, very good question, right? There's a lot of talk about how, okay, let me answer your second question first, right? Lots of people talk about scanners and all this kind of thing, right? Proprietary scanners, right? Or go my course and I'll give you this special scanner and whatnot. Personally, for me, I don't use any scanners. My portfolio is very focused, right? I don't diversify by ticker symbols because it's a lot of things to monitor, right? I am more of a focused investor. I think in my portfolio, I have about 3 to 4 stocks only, right? I only monitor about 3 to 4 ticker symbols, right? And that gives me a lot of, that streamline my process a lot, right? I go by a route called a very focused investing, right? What is the strategy that works best for me? I really enjoy using this strategy we call verticals or spreads, right? Spreads, I find it, okay, although I say there's no such thing as a universal strategy, I still like to use spreads in all market situations. And that's a bit of a cheating because a vertical spread is a category by itself as well. There are 4 different spreads that you can do, the same like the 4 basic legs, right? So I can do a bearish spread, I can do a bullish spread, I can do sideways spreads, right? So I like to use spreads in any situation. I just adjust it to fit the moment, right? So that is really my favorite strategy. Another thing I like to deploy is, in general, all my strategies are data positive. So anything with time decay element, I don't deploy, right? I like to have a positive time growth, right? What's the word? Appreciation, time appreciation rather than time depreciation, right? Time decay versus time, the inverse of time decay, right? All my strategies capitalize on the time element as well, right? So that can be verticals, that can be wheels. I also like to do wheels a lot. Wheels is another strategy that's perfect for this sideways market, right? A wheel strategy is simply holding 100 stocks and selling calls, right, when appropriate. And then when you do get exercise, you do a sell put when appropriate. And throughout the whole process, you keep on collecting shares, right? You just DCA along the way, right? If you want to know more about wheels, maybe I'll do like a video about wheels or something, right? I have planned to do that for my YouTube as well, right? Let's see. So Sean asks, since I'm a full-time investor slash trader, what is my plan when withdrawing money for my monthly expenses, right? We should not do it so often as there may be some losses due to the exchange rate. Yes, that is absolutely true. There will be exchange rates and this and that, right? So for me, what I do is that I don't withdraw so often, right? My plan is to withdraw only once a year, right? So you can calculate what is your roughly 1 year's expense, and once a year you just withdraw in one lump sum, right? Then along the way you can, like, you need to think about it this way, right? When we invest, you don't want to wait and collect a huge sum of money and then invest in one shot, because you are wasting a lot of you're wasting a lot of the sideways, you're wasting a lot of time by saving money and then one shot invest, right? But if you want to take out, you also don't want to waste time. So you take out all in one shot rather than piecemeal by piece, right? If you take piece by piece, you are actually negating your potential compounding growth, right? Compounding growth is a double-edged sword. So you should put in bit by bit so that it compounds, but when you take out one shot so that your losses don't compound, right? Because if you take out piece by piece also, then it's also compounding losses if you take out piece by piece, right? So what I usually like to do is I like to, one way is to keep track of what you need in 1 year, right? What is your 1 year salary? Then you take it out in one shot. Then you yourself portion it out in real life, right? That of course requires a lot of discipline, right? Some people spend everything in the first month or two, right? So that also trains you to exercise a lot of self-control, which is very important for a trader, right? I see Terrence, you withdraw once every 3-4 months. That's also fine, right? I don't advise every month you withdraw, because that's really compounding losses, right? You put in, then you take out, you put in, then you take out. It doesn't really, you don't benefit from the compounding, right? You don't try not to take out so often, right? But if you do things like wheel, then maybe you can just take it out. If you're not wheeling, if you're not buying stocks anymore, then you can just take out, right? But of course, I advise against, right? You don't want to compound those losses, right? You want to compound your wins, right? So let's see. Dave says, okay, I'm not sure how to cut loss for losing verticals that are 2 weeks away from expiry. Verticals is a bit more tricky, right? You do need to be aware of the price movement. That's why I say the number one thing you really need to be aware of is your whole charts in general, right? If you do a vertical here and then your vertical is about to exit on top, or if you do a vertical at the bottom and you see the price is about to change direction, please exit, right? This applies for everything you do. The price of the price movement of the chart is the most important thing. If you do here, whatever is it you do here, you exit here, okay already. Doesn't matter whether it's a vertical or a buy call or anything, right? So you just need to follow the direction of the chart. The moment it's about to change direction, you just exit off the top, right? You just exit. The moment it's changing direction, you just exit, right? Then you'll be good, right? That's how you, and then because once it starts to flip, that's when you lose already, right? You lose once it changes direction. So you don't want to let it change direction. You want it to exit, and you want to exit before it changes direction, right? When it go up, it will usually stay there for like 1 or 2 days. That's when you just need to exit the thing, right? You don't want to wait too long, and then it's really start to degrade, and then you are like, wow, I should have exited yesterday, this kind of thing, right? So so Dave still asks, Dave, next question, tagging to Sean's question, I am struggling to decide a trade to hit monthly targets like a salary to pay expensive trade longer term. So target set stress my decision. I exit too long. Okay. So this is a psychological thing already, right? I would not. Okay. So if you do need to keep track of your progress, but not in the way you think about it, right? What we are looking for is not amount of money that we win. Okay. What we are looking for is whether we are consistent in earning any money at all, right? So you don't want to peg your lifestyle to your trading just yet. I think many of you guys are not ready to go full-time yet. So you don't stress yourself in the wrong direction, right? You first things first, need to make sure that your basics are correct, right? Your entry is correct, your exits are correct, right? So you do need to make sure that you consistently get the exits correct. If you are still unsure how to exit, then you are not yet ready for full-time trading, right? You must be clear on your exit, more important than your entry. Once you have found your rhythm, you can do it regularly, you know where to enter, you know where to exit, then you can start to look at how much money you are starting to earn, right? As you get better and faster at this, right, you can take on bigger and bigger trades. Your portfolio will just grow naturally, right? Like Mark Minervani, like I like to say, right, if you are not losing, by default, you are winning. So you just need to keep track of how well you are maintaining your losses, right? You need to take profit in order to grow, right? So once you have that rhythm, once you are very clear on your strategy, right, then you can start to design your life around how well you are trading, right? So I won't do that so quickly, right? Sorry. I won't do that so quickly. I will make sure that I know what I'm doing first before I decide to go full-time, right? Right? So make sure you don't have all of these external things like I'm very stressed about whether I'm hitting my targets, this and that. In this market, right? In this type of stock market, your targets don't matter, right? The stock market doesn't care about your target, right? You can tell yourself, I will exit at 80%. The stock market, right, is not going to give you your 80%. It will just give you, it'll show this, it'll show this, it'll show this, it'll show. It's up to you whether you want to exit here or you want to hold for your own reasoning. I want 80%, so I'm going to wait until 80%. It's not going to give you 80%. It will give you whatever on the screen. You take it or you leave it. So you just need to accept that, and you need to build your strategies around what the environment is all about, right? This is how you need to do it, right? Let's see. Tony Derry asked me, what's 4 stocks am I trading nowadays? Tesla? I think that's about it. I'm wheeling my Teslas, right? My portfolio is not exactly very diverse, right? My mains are Tesla, Facebook, Disney, Amazon. That's about it, right? And doing verticals, right? Like I mentioned, wheels is on Facebook, Disney, Tesla, right? That's about it. Very straightforward. Let's see. Let's see. Let's go down. Let's go down. Yeah, you should. So Dave, let's see. So Dave said basically I have a 1 year worth of expense. For me, I know how much I spend, right? So in my mind, I have an idea how I've been tracking my own expenses for very long already. So I roughly know how much I spend in a year. So I've designed my lifestyle around that as well, right? So it's a good idea to have a sort of accounting in your mind as well, right? It's a good idea to keep track of all these kind of things, of all the numbers, so that you know what is it that is realistic for you to attain, and then you shift yourself accordingly, right? So let's see. Yeah, so Terence is right? So don't keep focusing on withdrawing the money. Focus on learning how to trade effectively and consistently, right? Once you can do that, then the money is no issue already. Really, you don't need to think about it, right? You just do the trade and then you win the trade, right? And then the money is the result of winning, right? You don't focus on the price, you focus on winning the game first, right? And the price is a secondary, right? You don't need to think about it so much, right? Yes, process first over your profit, right? The profit is a result of good processes, right? If you don't have good processes, you will not get good profit, right? So you do need to understand what is it you're doing and make sure that it's all proper, right? Right. So yeah, that's some psychology stuff for you, right? Sean says, Dave, if you don't want to work, right, you have to spend prudently. Yes, correct. I think when I was doing a lot of entrepreneur stuff, I think I just eat cup noodles every time, right? So you do need to understand where your money inflow and outflow is going, and then you can design yourself how you wanna, what can be cut away and what is really important in your life, right? I think a lot of successful people also, organize their life in such a way that they know what is important and what is not, and then they cut away all those not important things, like I know Steve Jobs don't buy clothes, right? You just buy the black sweater and you only wear that kind of thing, right? Successful people don't need expensive things, right? I like to eat hawker center food. That's fine for me. My lifestyle is very low expenses kind of thing, right? So that's how you need to think about and reorganize things, right? And if you really cannot cut anymore, or it is not in your, I don't know, interest to go and downgrade your life, then you just need to find, right, more income sources, right? So sometimes there comes a point where you can't save anymore. You need to earn more, right? So you do need to, one way is very good that is you are in now is investing and trading. The other way is you work hard. The other way is you find some secondary sources of income, like start a side business, whatever, like anything that can earn money, right? You just need to do, right? If not, the money don't come from the air, right? You gotta go and work for it. You gotta hustle, right? All sorts of things, right? So Eileen asks, if your buy call is in loss, can you do sell calls to get some money back monthly? How to do, right? That is called the diagonal strategy, right? Outside, they may call it strategy X plus or all sorts of other things, right? Rent to buy to rent, lease to rent, right? Lease to rent or strategy X plus, right? You may hear these terms, right? The real name of this strategy is called diagonal. And how we do is very straightforward, right? First things first, like Alan already write some instructions, but I'll just illustrate as well, right? So first things first, you do need, right, a buy call, okay? So before you even deploy a diagonal, you do need a buy call in operation, right? You do need a buy call. So right now I already have a buy call in operation, right? So this one is the first thing. You need a buy call, right? And you follow whatever the rules that you set yourself to enter your buy call, right? Best things is to enter the buy call at the bottom, right? So you have one buy call, long term, 500 days, right? 2-year buy call, right? So some people already have lead calls in place. You can do it on existing buy calls that you already have, right? Like your lead call not making money anymore, starting to die, right? You want to rescue, right? Can convert into diagonal. So first things first, you have a buy call. Now the second thing you want to do, right, is to take note of the price at which you have your buy call at. So 170 was my call, right? Now we take a look at the chart, right? Now here is where you want to do your sell call, right? You want to do your sell calls really at the top, okay? You want to do your sell calls at the tops if you can, right? If you don't want your buy call to go kaput, right? Of course, some of you may have a buy call at a higher price in the past and then they crash down. So right then, you really need to be more watchful, right? You really need to be more watchful. So you want to do typically you want to do a sell call higher than your buy call, right? For beginners, I advise the most edge case is at the same price at which you buy your call at, right? So mine is a 170 call, right? So what we want to do is we want to sell call every month, right? Right now, let's say 17 September too near already. I'll take 15 October, right? And I have a 170 call, right? I have the 170 call. This side, right? 170 call, right? So what you want to do is every month you want to sell call at a strike that will move away from your price, right? You notice that the closer you are to the current price 181, right? 180. The closer you are to the current price, right, the more premium you will receive, right? The more premium you will receive, but it's a bit risky for beginners. So you want to make sure that you want to choose somewhere where you will not get hit, right? A sell call gets hit when the price goes up, okay? When the price goes down, that's when you are safe, okay? So you typically want to choose somewhere where the price will unlikely to hit you. And that's where technical analysis comes into play, right? We know that this is the trend. We know that this is the trend. My FIBO says 100% mark is 182, right? The next point is about 185, right? If you are very safe, you can take the 185. If you are a bit more aggressive, you can take the 180. 180 is a bit here, maybe 185. We go for 185, right? 185 is not that far off also, right? You can take this one, right? From your 170 call. So I take 170 and 185 as my sell call, right? Something like that. And then you wait for the, you simply, what this needs to do to succeed is that the trade needs to go lower than 185, right? So you sell single, right? 345, right? So you just need to, as long as the price does not reach 185 and above, your sell call will generate a premium that will help to recover from your buy call losses, right? That's most of the time, a lot of people who do the leap calls, they find their buy calls dying and they need to resort to doing transiting into a diagonal to rescue their trade. But for me personally, I find the best way to rescue things is just to exit, right? The best exit strategy right now for us really is to exit the trade and don't waste time, because time is money. And the more you wait for recovery, the worse your trade actually becomes, right? So for me personally, I will just exit at 10% losses and redo a proper trade, right? Some of you guys may have done a leap call that is very high up already, right? And then the price crash on you. I would just cut those losses, because it's only going to get worse as time goes on and more difficult to recover. So I would just straight away exit the thing. I don't want to, time is compounding. The longer you keep a losing trade, the more those losses compound, right? Whereas it's the same way for winning. Winning trades have compounded profit. Losing trades have compounded loss. The compounding is just by default all the time. So if you have a losing trade, you don't want the compounding effect to happen, exit quickly, right? If you have a winning trade, you can leave it because you want it to compound. Losing trade, exit quickly. That's really the best way to cut loss. I won't bother trying to transition into a diagonal anymore, because it's very difficult. It gets harder and harder to recover as time goes on, right? Especially if you have a 2-year one, you have 2 years of compounding to fight against, 2 years of compounding losses to recover. So if you at the very start close off already, right, you won't have this issue for the next year, right? It will simply be gone the moment you cut it. And then you can focus on how you want to do your recovery, right? So basically, I cut loss at 10% for all transactions. Yes, I try to do that. That is the best practice, right? Of course, it's not so easy for beginners or even for experienced people, because it's a very emotional type of task. But try your best to cut it as near as possible. 0% you can cut, right? Minus 10% best to cut, right? 30% is the furthest I go, right? Minus 30% is the slowest I cut. Minus 40, minus 50 is too slow already. It's considered very difficult. You have to cut it. If not, it'll just get worse and worse, right? But the optimum time to cut is minus 10 to minus 30%. Anything beyond that is going to be a struggle to recover, right? So you do need to plan how you want to, once you cut your trade, your next plan of action really is to look for the next trade to earn money, right? And when your old losses are removed, right, there's only upwards to go, right? You only need to worry about what's the next trade, right? Then you just earn. And the faster you cut, the less profitable trades you need to earn to make back those losses, because the loss is not so big in the first place. You understand? Right? If your losses are small, you don't need so many good trades to make it back, right? Maybe 1 or 2 trades and you make back your losses. But if your losses are huge, you need a lot more trades to make it back, right? So I would not advise holding losing position for so long, right? And that's what brings me to the very start of the session, where I talk about people who have a stocks background have a very bad habit of holding onto losses on options, right? People who have stocks background transition to options, right? They always feel that by holding onto your conviction, right? You hold onto your conviction. Wow, conviction, right? I buy a 2-year call, I'm just going to hold it and wait for it to recover. Is not the same, right? It's not going to work, because your losses grow and grow and grow, and then it's over, right? And then it's over. Okay, then the trade is over and you only have losses, you don't have profits, right? For 2 years, you hold on to losses and then it's gone. A lot of the stocks trader don't understand the element called compounding. They don't understand compounding in both directions, compounding in profits, also in compounding in losses, right? They only think in terms of eventuality. They don't have very specific time frames in mind, right? So yeah, the best practice really cut loss at 10%, close trade when it's the top, as simple as that. Correct, that is really, really, really correct thing to do. When the stock price go up and you reach the top, take your profits and go, because it's going to, the next step after stocks go up is stocks go down, right? And then you just lose all your profits, and then you must wait for the next round, right? And as you wait also, time decay is happening as you wait. So your losses actually grow and grow and grow while you wait, right? Or at least the amount that you need to climb to reach back the same point as you were in the past start to become wider and wider as your profits, your losses grow deeper and deeper, right? So you do need to be aware of the double-edged sword that is time and compounding effect, right? So your losses, don't let it compound, cut it. But your profits, it's okay to let it compound. But in this market, it's not going anywhere. The stock market is sideways for 1 whole year. And if you do positions that have time decay, it's going to decay and compound. It's going to compound the decay on you, right? So you don't want to do things like that, right? That's why those leap calls are dying. And when they do recover, they recover very little, because the amount to claw back is very big, right? It's grown while they waited. While they wait for recovery, the losses grow and grow and grow. And then when the recovery comes, the loss is so deep, right? Then when they grow up, then only a little bit is profit, right? For 1-2 years, they wait for such a small profit or even negative, right? Then no point, right? So I won't do that, right? Let's see, what if the options are good names? So Dave asked, right? I'm starting too long trade, 50% loss. Hey, I would still exit, man. I would still exit. It will become worse. You know that? It'll become worse. It will become 50, it will become 60, 70% loss. And you do need your stock to really, really recover back to where it started and more, right? It needs to go higher than where it started as, and then your profit will be very little, right? It will really not be worth. You could have done so much more because a 2-year trade is very expensive, right? 2-year trade is very expensive and you cannot access that money. And for almost 2 years, that money is degraded. It will not grow back, okay? What you could have done is that you just take the money back out, liquidate into cash, and do something while those positions are consolidating, right? Those stocks are not going to go anywhere. It's just sideways. It's not going to go anywhere. Take that money away because you are losing it to time decay, right? Time decay is rotting your trade for no reason, right? I don't know why you're holding on to losing trade, right? Time decay is rotting you for no reason and it's growing and growing at more aggressive rate. So you do need to faster take out that money and do it in something that can grow, right? Do it in some profitable things, right? You are thinking you want to have a good cash flow, right? You want cash flow. You don't want stagnation, right? And stagnated money lose to time decay, right? So you do need to take it out and you actively churn it while you wait for your stocks to grow, right? The stock's not growing, right? It's sideways, right? You just said, well, it's very, very good, but it's sideways, right? Don't worry about it, it's not going to go anywhere. Take out the money, go and do something that you can do, right? Rather than wait for the thing to grow, right? It's going to waste your money while you wait, right? Time is real money, right? Time is real money. Time decay is a thing, right? So don't waste time. Yeah. Let's see. So Eileen asks, which is better way to buy call? Buy in the money, right? Best is buy at the money. So you see the current price, and then you do 1 or 2 strikes away. I'll show you. Okay. So Disney is at 181. The best place to buy calls, right, is 180 or 185, right? 1 in or 1 out. That is the most I'll do for buy call, right? Here or here. Of course, it's 181, so I would rather go this one, right? I'd rather go this one, right? Because why? How a buy call profits is that anything beyond the strike you chose is profit already, right? So if I buy 180 and the current price is 181, I already profit $1, right? I know outside they teach something like buy far out of the money, right? Perhaps they buy 200, something like that. And then their reason is because it's cheap, right? It's cheap versus this one, right? $23 versus 15 cents, 23 versus 15, right? They say, oh, you buy out of the money and it's cheap. But you need to know that the stock price must exceed your strike price and beyond. Then everything else beyond that is profit, right? So if the price never touch you, you have chosen a ridiculous number like 300, right? And Disney is not going to reach 300, right? Right now it's like 180, unlikely that reach 300. So from now until it ever reach 300, you are losing money, right? And you're waiting to let it reach 300, but while waiting, same like Dave, you are losing money, right? Any trade that is losing money for too long start to accumulate losses. So you don't want to accumulate losses, or you don't want to hold losses for so long because it compounds, right? And when it's time to recover, it's very hard. It's an uphill struggle because the hill becomes steeper and steeper because the losses become so big that you need a lot of movement to recover back. And if the stock is not an explosive stock, it's very difficult to recover back, right? So this is very good questions, right? I think a lot of you guys are talking about how time affects, or at least the root of the problem really is time. See, like I said, right, this whole session has really been me nagging about don't hold on to losses. I don't care whether the stock is very good or very bad, or at what price you buy. Losses and profits both can compound. And if you are not compounding profits, you are compounding losses, right? And it's very hard to recover from a compounded loss because you need the time to compound your profit to make back the time that you compounded your losses, right? If you wait 1 year and you generate 1 year worth of a heavy loss, then you need 1 year worth of a heavy win. And how confident are you at winning if you cannot even handle your losses, right? So you do need to be aware. If you make 1 month loss, right? If you lost in 1 month, right, then you exit. It's a small loss. Your next month win can make that back. But if you 1 whole year loss, then you need 1 whole year of win, right? So you need to maintain those losses. You need to have a very, very tight tracking on all your losses, right? Mark Minervani teach to exit at 10%, right? And that's really the very simple strategy to keep your profits, right? If you don't lose, you win by default, right? If you're not losing, your winning strategies are compounding. If you don't have compounding losses, you only have compounding wins by default, right? You don't need to do anything, right? So that's really the strategy. That's really the crux of the problem that I do notice. And even in this conversation today, the topic, the root of the problem really is still exactly the same as what I've been talking about this whole year, which is time compounds both ways. You cannot hold on to losing positions, right? Those stocks people teach you to hold conviction, right? If you hold stocks, then okay, right? If you hold stocks, then okay, because stocks got no time decay. But if you're doing options, best not to hold too long, right? Just exit when appropriate, right? Because you only got 2 years at most, and if your thing don't make money by the end of 2 years, the whole thing is a loss, right? You can't hold for 10, 15 years. There's no option so long, right? So that's the advice. Yeah? Good. Any more questions? I think my moderators have saying I drag on for too long, right? So any more questions for today before I end it? I think I talked a lot about different things, but at the end of the day, actually it's the same thing, right? There's a lot of different problems that many people have, but the root of the problem, right, if you filter down everything, why they're all losing is really because people are holding on to losses, right? And losses compound, simple as that. So you do need to take this, if you're gonna take anything back from today, just remember that don't let your losses compound, right? Just 10% off the bottom. 10% is the maximum that you want to go. If it goes a bit worse than that, you just exit. It's okay. You can re-enter any other time, right? There's so many strategies, right? Right. So can you use Strangle to make profit both ways? Strangle is what again? It's a buy call buy put, is it? Or sell call sell put in the center? What is a Strangle? I don't really use Strangle so often. I don't really like Strangles and straddles, right? I find them a bit open-ended. Buy call and buy put. Okay. I rather not, right? Because for Strangle, you do need a big price movement to make money, right? If you look at this, let's just look at a Strangle, right? Let's just try out one, 180, 175. Right? Dino is saying too long already, right? Look at a Strangle at 180, 175. You do need a huge price movement to benefit from Strangles and straddles, right? Look at that. So we've got, in order for your 180, 175, right? We take a simple one. In order for it to make money, it needs to move, right? The center point is around here, 180, right? 194 or 161, right? The range is 60 to 90. It's about $30 range. So you do need a very, very big move out either way, and then you make money, right? If the stock rotates sideways, right? 181 to 170, $10 move only. 180, 170, 180, 170, 180, 170. Our range is here, right? 180, 170. 180, 170. You will not make anything, right? You will be in the center, $45 or $11, right? It's very crappy. And then along the way, you start losing. You can lose up to $1,398 if you're looking at these numbers over here, right? It's crappy. I won't use Strangle in this market because it's sideways, right? Right? So I won't use Strangle. You need big movement for Strangles to work properly, right? Right now, we don't have big movement. We have very narrow movement. So this is not really ideal, right? Do I check the average IV percentile for a ticker when I do a long call? IV percentile, I do check IV percentile, right? Like I still do, because the best way to capitalize on buy positions is you buy them cheap, right? So I do always want to, if I buy anything, I always want to buy it cheap. If it's not cheap, I will not buy, right? Wasting money, and time is money, and the time will eat away the money that you spend, right? And it's very hard to recover back. So I don't want to spend too much if I'm buying a long-term position, right? If anything, I will buy at $0 if I can, right? And that's a more advanced strategy, right? Those are all the synthetics that I like to deploy nowadays, where I spend nothing to go open up a trade, right? That's really the best. Free is best, right? Let's see, yeah, I think, right, my moderators all very angry already. They don't like me talk too much, right? I can see, all right? Okay, so with that said, I think I dragged on for about 20 minutes over time. But I hope you guys enjoy this session, right? Let me go back to the slides. Yeah, I closed the slide already. Whatever lah, right? Feel free to follow us at this place, www.investors.club. Okay. www.juniorinvestors.club. Right? That is our official website. All of the content is in there. The free stuff, right? All the basic stuff is in there as well under the previews, right? And if you've still got any more questions regarding any of these kind of things, feel free to message me on Facebook. Message me on the you can't message me on the Telegram. Only our exclusive club members can talk to me directly on the Telegram, right? But if not, you can message me on Facebook, or you can message our Facebook page, right? And yeah, hopefully this session has been useful for you guys, right? Once again, www.juniorinvestors.club. If you want to know more about our program or join the community, then you can ask or just straight away join, right? $97 per month subscription won't damage you. Hopefully will not damage you so much, right? Should not. if really is a stretch, then if you cannot support $97 per month, then perhaps a day job is still required, right? Perhaps you are not yet ready, or your expenses are too tight for such a thing, right? Because you do need a certain amount of capital in order to start trading properly. So if you cannot, if 97 is still a bit too much, right, then maybe you're not ready yet, right? I don't advise you to damage your life so quickly, right? Okay, very good. Thank you for listening to me talk for an hour and a half. Hopefully this session has been useful, right? And with that said, any more questions, just ask me on Facebook or ask me in the Telegram for those inside Junior Investors Club. And I'll see you guys in the next free thing. For those of you outside, right? Once in a while, I'll do a free video for you guys to come in and join. But for the rest of you guys, I'll see you in the chat. And then we have class every Tuesday and Thursday, right? Ending the session in 3, 2, 1. Bye.